Okay, fun seekers, are you ready? Oh boy, we've got something great in mind for you. We're going to slog through a typical 1040, Form 1040 tax return for the typical homeowner. Now, it might be a good idea for you to print these documents out. It's up to you. In the face-to-face class, of course, we would pass them out. But we're going to work with the first tax exercise, which also has Schedule 1 and Schedule A. Don't print out the tax tables. We'll take a look at them, but they're dozens of pages. And here are the actual IRS website documents that you can download. So you might want to have at least the first tax exercise printed out and maybe even Schedule A. Schedule 1 you don't really need to print out because we'll refer to them as we go along. But it's really nice to have that first tax exercise printed out. So let's start on slide number 11. With the Republican tax cut of 2017, the IRS decided it was a great opportunity to overhaul the method of reporting our taxes. The 1040A, which really wasn't that useful, and the 1040EZ, which was really useful, were scrapped. Now everyone is going to use the Form 1040. And the Form 1040 has been simplified. Whenever you hear that with regard to the tax code, know that that's a total lie. It used to be 2 pages. Well, it's still 2 pages, but now with an additional 3 schedules depending upon your situation. And how could anyone possibly state with a straight face that adding an additional 3 pages is simpler? Add to that the confusion of which 3 pages to use. I'm still pretty confused. Oh, but take heart, dear students. In 2019, it's now an additional 6 pages. But most people are not going to use the many pages. Most people are going to, if you don't have a home, you're probably just going to use the 1040 and maybe Schedule 1. If you do have a home, you're probably going to use Schedule A, which is the homeowner's friend, and what we're going to spend a goodly amount of time today. So please, I know it's going to take a while, but relax. You can always stop the presentation, start it again. We're not going to break it up into 6 presentations or 10 presentations like they tell us to. It shouldn't be more than 4 minutes. Oh, give me a break. Slide 12. 1040 form, page 1. There is identifying information, Social Security numbers, address, dependents. The signatures, they go on the back now. They used to go on the front. Figured that one out. The Social Security numbers of dependents must be included unless your child was recently born, and there is a grace period for you to get that Social Security number. If you forget to sign your return, which a lot of people do, if you can, hard to believe, that's the most important thing. If you forget, contact the IRS as soon as possible. Don't send another return. Now, it's very interesting that in 1987, the IRS started requiring taxpayers to include the Social Security numbers of dependents, typically children, right? 7 million children and other dependents mysteriously disappear. Would anyone cheat on their taxes? Yeah. So let's go over to the tax return. Now, again, all these things are on the website and in Canvas, of course. We're looking at the first tax exercise here. So, oops, did I do that right? Yes, I did. Okay. Here it is. A king back. A king back. Yeah, I know. A king back. His Social Security number is placed prominently, and it's bizarre. They used to fit nicely in here, but now they sort of, when you type it, of course you can write it manually, but when you type it using a PDF program, it sort of meshes it across the name, across the Social Security number. Then if it's a joint return, you put in that person's name, your address. Now, if you're outside the country, you fill that in. Here's the presidential election campaign, which nobody uses, and I don't recommend you use because the candidates don't even use it. Because if they take the money, then they're required to stop taking money from the billionaires, and they don't want to do that. Now, here's the filing status that we'll discuss in just a moment on the next slide. But a king is the head of household. Why is that? because he has a child, Wayne DeBack. Wayne DeBack, yeah, Wayne DeBack, and it's his son. So he's going to get. Oh, we forgot to click this. We should check if it qualifies. Yes, child care. We're supposed to click this guy here. We click this guy because Wayne DeBack is less than, I think, 17. You have to be 16 or younger, I think. And so we're gonna. I forgot to click that. I'm clicking that right now. So this is the dependent where you have to have the Social Security number. Now, if your child was just born and in December or something like that, you don't have enough time to get that. But there's a grace period. Next year, you better have it. They've added this digital assets because many people think that if they sell crypto, they don't have to report it to the IRS. But yeah, you do. And if somebody claims you as a dependent, you have to declare that. And if you're over 65 or blind, you get some extra perks. So they want to know that. So that was the beginning of the 1040. Pretty straightforward information, right? Slide number. Okay, we'll discuss this in a little bit. I thought we were going to discuss the different types of filing statuses right here. We'll get back to these guys. Single, married filing jointly, married filing separately, head of household, and qualifying survivor spouse, a widow or widower. So we'll discuss those in a bit here. But now let's get to the middle of 1040 form. And this is a lot of, people tend to look at the form and just freak out because there's so many lines. But most of the lines are not applicable to most people. They really aren't. But it still scares everybody to see all these things, these lines, and go, oh, I have to know. But no, you don't have to know about these. Mostly what people are interested in is line 1A, the total amount from your form W-2. And if you have more than one, you have to add them together. And then a few of these things that are not that important. And then we add these lines all together, and we get line 1Z. A, B, C, D, E, H, H, Z, I. And so these two lines are usually filled in. The next line is if you have interest. Now, for many years, the interest on your savings account, your checking account was nothing. Now they're starting to pay more interest, so you might have some taxable interest. And you will get a 1099 that describes how much interest the institution has paid you. And then more things that most people, IRA distributions, pensions, annuities, Social Security benefits, most working individuals are not going to be affected by that. So we just ignore them. And then here on line 9, we add up what's from 1Z, the total of the first group of items, and then the total from the second group of items, and we have $62,000. So A. King made $61,900 from his work, a total of $100 from his savings, his interest on his savings, and he has $62,000 of total income. Are you with me? All right. But now there's number 9, also sometimes called gross income. But now we're going to say, look. He has some adjustments. Some people call them deductions, but that's a different form, but they're basically the same idea. We're going to reduce that gross income by a certain amount. And this is what used to be on the 1040, but they took it off and made it onto a whole other schedule where most people are just going to do 1 or 2 at the most. So let's run over to Schedule 1, where we have Schedule 1. Here it is, Schedule 1. And you see the first page is completely blank. Put your identifying information at the top of the page. But the first is additional income that, again, most people are not interested in. If you have a business, if you have rental property, a farm income, so unemployment compensation would go here. But most people are not interested in this. We're going to go to page 2 and see that, he put $1,000 into his IRA, and so he puts that there. And he paid $1,000 in student loan interest, and so he puts that there. And we have a total of $2,000. So that's what we saw back on the form 1040. we saw that, oops, wrong one. We saw that he was able to reduce his total gross income by $2,000. $1,000 paid to a traditional IRA, and we'll discuss IRAs in the end of our journey together here. And he paid $1,000 in student loan interest. So now his total gross income has become $60,000. We reduce. And you know, people are really frightened by these. Sometimes people will add, and then they'll get this letter. So obviously that's the wrong way to do it, right? You're supposed to subtract here, and it says subtract line 10 from line 9. But some people will add, and then you'll get this letter from the IRS saying, "Oh, you goofed," and people freak out because it's official. It has on the envelope it says official business, and only on. Yes, just relax. Most audits are just because people did the wrong thing or added incorrectly or subtracted incorrectly. So now we're down to the adjusted gross income, which is a very important number. The adjusted gross income is a very important number, and we'll come back to it later on. And now here's where the first major confusion comes from, apart from just seeing all these lines that most people aren't interested in. You get to take the standard deduction or the itemized deductions, but not both. So let's go back to the presentation. We're getting a little ahead of ourselves. Here we are. We've gotten down to the adjusted gross income. The adjusted gross income is an important number. Many tax items are tied to the adjusted gross income, such as the ability to contribute to your retirement accounts or utilize certain deductions and tax credits. So that's a pretty important number that we'll come back to. So now let's go to, this is the discussion we had on Schedule 1. The Schedule 1 has additional income on the first page and then adjustments to income. And we took advantage, our A King Back is taking advantage of his retirement contribution to his IRA and the student loan interest. So those things used to be on the previous 1040 form, and they put them on the Schedule 1, and then Schedule 1 just got huge. Whatever, you give them another page, and the IRS will fill it up very quickly. Now, here's where the confusion can start here. The standard deduction is for everyone. Everyone is eligible. Doesn't matter. This is where we get back to those filing statuses. Single. Most people are either single or they're married. Now notice, every single person gets $13,850. Married people get $27,200. This is going to reduce your adjusted gross income before you decide how much taxes you're going to pay. Or you could itemize, and you hear about itemizing deductions, gifts to charity, medical expenses, mortgage interest. Most people are not going to be affected by this itemized deduction unless they have a home. And that's why we often call Schedule A the homeowner's friend. This is an important concept that will be on the exam, but it's important for you to understand that you get to take the standard deduction or the itemized deductions, but you can't take both. And why do we say that? Because some people will give money to Father Joe's, Village, or Southwestern Community College Foundation, or the public radio station KPPS, or the KSDS, the jazz station, and they're all charities. And you get a little thing in the mail saying, okay, you paid $100 to KSDS. And then you take it to your tax preparer and say, hey, I got this deduction. And they say, well, do you have any other deductions? No. Well, it makes sense for you to take the standard deduction, which is $13,850, because your itemized deductions don't go anywhere near close to that. Are you with me? So let's go back to the 1040 form and take a look at the filing statuses. Remember, we said most people are either single or married filing separately, but in A. King Back's situation, he's a single parent and he's the head of household. Now, this is where other confusion can happen, because both parents, if they're separated or divorced, they might try to take the head of household, and eventually the IRS will say, no, you can only have one head of household. So let's go back now and take a look at the standard deduction. Notice, as we said, it's $13,850, and I apologize if you're trying to watch this on your phone, but that's why I ask you to print it out. it's $27,700, which is basically twice that for a married, or if you're a widow or widower, and I think they give you 2 years, in which case then they make you single again. Head of household. So here we go. Head of household. A king can take $20,800 off his taxes, off his adjusted gross income, as a standard deduction. He doesn't have to itemize. He doesn't have to say anything. He just takes $20,800. But notice that he wrote down $27,000. So for him, his itemized deductions were greater than the standard deduction. So he went ahead and took the $27,000 as itemized deductions. Now, do you just get to tell the IRS, okay, I paid $27,000 in itemized deductions? No. You have to itemize, enumerate, list those on Schedule A. So let's run over and take a look at Schedule A under First Income Tax Exercise, Schedule A. On Schedule A, you will see a list of various deductions. And you'll see, oh, the first ones are medical and dental expenses, and then taxes you've paid, and interest you paid, and any gifts to charity, any losses that you may have had, and then other itemized deductions, where there's a whole list of many of them that most of them don't apply to most people. And so this is where we itemize. This is where we list those. Now, do you have to include the receipts? No. They might send you a letter saying, please, make a copy of the receipt and send it to us. And some people will make copies and send it in with the return. You don't need to, because much of this information they're going to get electronically, especially the home mortgage interest and the taxes you paid and the like. But, that's okay. They have these algorithms that basically check, oh yeah, this makes sense. That's about the right number that people would pay. And if there are any red flags, where you said you donated, $30,000 to Father Joe's village and you only make $40,000 in a year, their algorithm is going to kick it out and say, we think this person's lying. So that's how it works. So he paid $1,000 in his state income taxes. You can either do state income taxes or the general sales tax, but you can't do both. Here's his property tax for his condominium. His $200 that he paid to the DMV, the personal, no, what's it called? Oh, darn. Vehicle license fee. Vehicle license fee, I think it is. It's basically a property tax, but on a car, not a house or a condominium. And then we add these three together and get $6,550. Now notice, we're going to see this on the slides. You cannot go more than $10,000. This is called the state and local taxes, and this was instituted in 2017 as sort of a hit, as a punishment to the high tax states like California, New York, Chicago, which are predominantly Democratic, and the Republicans just wanted to stick it to the Democrats, and there was a blowback. We'll see later on. Now notice $6,500. Why didn't A King declare any medical expenses? He has a son, Wayne, to back. Obviously, they must have spent. No, wait. You add up all your medical and dental expenses, and if they are not greater than 7.5% of the adjusted gross income, they say enter the amount from line 11. They should say enter your adjusted gross income, but people don't know what that is, but then they have to go run this to the other form, and if you go back to the other form, you'll see line 11 is the adjusted gross income. If it's not greater than 7.5% of your adjusted gross income, then you don't get to deduct it. Anything above 7.5%. So you really don't want to take advantage of this because it means somebody's sick or you're paying an astronomical amount of money in health insurance, which some people do. So this one usually doesn't account. So we add up the medical expenses and dental expenses, which are usually zero because they're not greater than 7.5%. Are you confused yet? That's okay. You're not alone. And we add up the state and local taxes. And we find that we're nowhere near the 18, that what was it, 20,000? I forgot already. $20,800, right? It's got to be $20,800. So we're nowhere near that. What puts most people over the standard deduction is the home interest, the mortgage deduction, which there's quite a bit of controversy now over the mortgage deduction, and we won't get into the politics of it, but they say, oh, it favors the rich because only rich people own houses nowadays. Well, there's something to be said about that. We need to build a whole lot more houses. But this is the one thing that we're interested in, the big one. This is we call Schedule A, the homeowner's friend, $20,250, which is not unusual, folks. Some people are paying, $1,000, $2,000, $3,000 a month in interest. And again, the Republicans wanted to stick it to the high income states, the states with the highest housing costs, and they've limited how much your mortgage interest you can deduct. Notice, your mortgage interest deduction may be limited. Oh, by the way, all this disappears, as we said in the first presentation. All this disappears after 2025. Yeah. And then A. King paid $700 to Father Joe's Village or KPBS or Jewish Family Services or whatever. And so that's a charity. Now we add all those together. Again, these guys, not usually casualty theft losses are not usually something that we don't want to happen. And then other itemized deductions, again, they're not that important. Maybe it'll look through the list. Maybe it'll affect you. Usually it won't. So $27,000. So there's the itemized deductions. And that's what we find that he took. A. King Beck took the $27,000 as itemized deductions. And he's going to be able to reduce his adjusted gross income by that $27,000. This guy right here is if you have a business. And that was instituted in 2017 and will disappear after 2025. So A. King takes the $60,000 of adjusted gross income, see it's line 11, subtracts the itemized deductions, or the standard deduction, but not both. In this case, he does the itemized deductions. And he winds up with a taxable income of $33,000. So let's go back to the presentation, and where are we? Yeah. So here we are. We said you get to take the standard deduction, you get to take the standard deduction or the itemized deductions, but you can't take both. And so here is what we've already gone through. We've gone through this Schedule A. Medical expenses, taxes, interest, gifts to charities, many other deductions were removed by the Republicans in 2017. And again, if they don't do anything next year, this year, whatever, 2026, it all goes back to what it was before. Now, we said the qualified business income deduction was for people who have a business. This thing has caused tremendous confusion. And it was meant to mirror the tax cuts that the corporations received. So I forget who it was. One of the senators from the prairie states said, well, you're giving the corporations these big tax cuts. Why don't we give small businesses tax cuts? The provision is rife with limitations, exceptions to limitations, phase-ins, phase-outs, and critical but poorly defined terms of art. So, I don't understand. I've read through it, and I don't understand all the exceptions. I just type in this stuff into one of the. I use TurboTax, and TurboTax figures it out. And I don't know if they're doing it right. I can't figure it out. So finally, we've made it to our taxable income. We've finally determined how much of our income is taxable income. Did I get the lines right? Yeah, line 15. I got it right. Oops. What am I doing? Yeah. Back here. Sorry. So we finally now know our taxable income. And the taxable income is used to compute the tax due. However, there are a few methods, and we need to determine which method we're going to use. So most people are going to use the tax tables, up to $100,000 of taxable income. But once you go above $100,000, you need to use the tax rate schedules. If you have capital gains, then you need to use the Schedule D method. And there are some people who are affected by the alternative minimum tax. Holy mackerel, right? Yeah. we're going to use the tax table because that's the way most people do it, up to $100,000 of taxable income. The system that we use is called a progressive tax system. All right, we're going to discuss the progressive tax system and the marginal tax rate. Remember from our previous presentation, it's important to know your marginal tax rate. There are now currently 7, right? 10, 12, 22, 24, 32, 35, and 37. They're going to go back to what they were in 2025 before this. And we're also going to take a look at the average tax rate, which is a very simple calculation. You take how much taxes due divided by your taxable income. And this is promoted by many of the flat tax folks who just want to say, forget all these marginal tax rates. Let's just have one tax rate. Yeah. But we're not done yet. There are more issues that we'll revisit after we discuss marginal tax rates. So here are the marginal tax rates for 2023. But we don't have to use this table. This is what you would use if you go over $100,000. What we're going to do is we're going to go to slide, the next page, line 16, and we're going to, see it says see instructions and good luck. We're going to go to the tax table. We're going to remember that our taxable income was $33,000. So now here, we're going to use the tax tables. Again, don't print this out because it's dozens and dozens of pages. And you can actually ask the IRS to send you a copy, and they will. But here we're going to download the tax tables. Here we're going to, okay. So here it is, folks. Tax tables, 27 pages, all of it. Only contains tax instructions. Okay, here's what we want. We start with 0 as our taxable income and then go through and find 33,000. 33,000. Here you go. If line 15, your taxable income, is at least but less than, you can't, once you hit that number, you got to go to the next line. You can't, here, you'll see 33,000 down here. But no, if we hit 33,000, you got to go to the next line. So here are those here are those the tax statuses that we talked about. A single person, married filing jointly, married filing separately. And again, you don't normally want to do married filing separately unless there's knives and court orders involved. And then head of household. This is a Kingbacks category. So 33,000 to 33,050, 3649. And people say, oh, it's so hard, look at all these numbers. No, it's not that hard. You find where your taxable income is, and then you go over to the category that you're a part of, and single, married filing jointly, married filing separately, or head of household, so 3649. So if you notice, I put in 3649. Now be careful, I make mistakes, we all do. So check my my procedures for the second tax exercise, and see, and yeah, don't worry about making mistakes. We all do. The IRS knows it. They make plenty of mistakes. Okay, so now that's, most people will just say, okay, that's a number we have right here. Schedule 2 has additional taxes, but most people are not going to be affected by that, and so we're going to ignore that. And then we have a subtotal here, 3649. And so let's go back to the presentation and discuss marginal tax rates. So if you're single, now we're talking just the taxable income. This is after the adjustments, after the deductions, after the standard deduction or itemized deduction, and we're down to line 15 with our taxable income. From 0 to 11,000 is at 10% for single people. Notice that for 0 to 22,000 is 10% for married couples. Why? Because there's 2 of them, right? So it's double. From $11,001 to $44,725, you're taxed at 12%. So what some people do, I got to go back and do the whole thing at 12%? No. That first amount is taxed at 10%, and then anything above that first amount, in the case of single people, 11,000, in case of married people, 22,000, is taxed at 22%. And then once you hit 44,726 for the single person, now you're at 22%. 89, 452, 451, 22% for the married couple. You see, it's a progressive system. Now, the tax cuts of 2017 gave the average poor family a tax cut of $60. The middle class saw an average tax cut of $930. Folks in the 95th to 99th income tax bracket got about $13,480. And the top 0.1% saw an average tax cut of almost $200,000. However, once the plan is fully phased in, taxes will go up for the bottom 40%, unchanged for the middle 40%, go down slightly for the 80 to 90%, and fall sharply for the top 1%. Surprise. Now, I remember Trump, and it's got a press conference with Gary Cohn from Goldman Sachs, who was his Treasury Secretary at the time or whatever, very important person in charge of taxes, saying, this will not affect us rich people. Right, Gary? Is it going to affect you? And Gary looked and said, no. They were lying. Of course it was going to affect them. Well, they're going to get better than the average person. But hey, lying is politicking. Is certainly some politicians, we won't name names, Trump, that's what they do. Better than they breathe. They lie. So that's the 2023 marginal tax rates. Now notice 2022, see what happened? The single person in 2022 was only taxed at 10% up to $10,275. So the tax brackets, the marginal tax rates, are adjusted for inflation. As inflation goes up, the brackets go up, not the interest rates. Not the tax rates, the brackets. And so think about it. If inflation continues and people start earning more money, they're going to move up into higher brackets. So it's basically like a tax increase just because inflation has gone up. So that's why the tax rates are adjusted for inflation. Now, from 2001 to 2012, the tax rates were temporary and adjusted every couple of years. After the fiscal cliff fight at the end of 2012, which many of you don't remember, when the Republicans said they weren't going to fund the government, and Obama said, "Well, you need to fund the government because And so it was a pretty scary after August in 2012. The United States government debt was downgraded. The rates became permanent until the end of 2017. The tax rates again are temporary until 2025, in which they go back to what they were before 2017. But the Republicans vowed to make them permanent, but they haven't done that yet, and it's probably not going to happen, depending on what happens at the election in 2024. Are you confused yet? Yeah, I know, it's pretty scary. Notice 2021, 9,950. 19,900. You see, the percentage rates normally doesn't change unless the Congress tinkers with them. The tax rates are simply adjusted upward according to the inflation rate. The 2020 brackets were lower than the 2021, the 2022 lower than the 2021. Remember, everything goes back to what it was before the 2017 tax cuts in 2026. Oh. So now let's see an example of how this was computed. Now I'm using a number 45,725 for a single filer. And I did that for a reason, just to make the calculations a little simple. So notice, let's take a look at the first 11,000. These are the 2023 tax rates. The first 11,000 are calculated at 10%. So if you calculate 11,000 times 10%, you get 1,100, and that should be $1,100. No, that's not right. I got the calculation wrong. I did this number right, but I messed up that number. Wait a minute. Maybe I got to check this out. I think I might have. By the time you see this one might be a 0. My apologies. Now, the anything above 11,000 is taxed up to $44,725 is taxed at 12%. So how do we do this? We subtract out the 11,000 because we don't want to be taxed twice, okay? You don't want to be taxed twice. You take the 44,725 minus the $11,000, and that gives you whatever it does. I forget what it was. 33,725. Yeah. And then you multiply that times the second tax bracket, or 12%, and you get $4,047. So the first group, the first bracket, is taxed at 10%, the 11,000 here. The 33,725, which is a very simple calculation because you take the, I just use this number on purpose. 44,725 minus 11,000 is taxed at 12%. And then anything above 44,725 is taxed at 22%. But not the whole amount, right? He only stops at 45,725. That's all his taxable income, this person's taxable income. So we subtract these two, the 45,725 minus the 44,725, and that I did that on purpose. It's $1,000. Okay, make it easy. That's taxed at 22%. So they added an additional $220. You add those three up, and the tax tables say 5367, and I think what's going to happen is it's going to be five. I think I have to go back and fix this because it's definitely a mistake. I'm pretty sure. I mean, I don't have my calculator handy, but 11,000 times 10% is not $1,110. It's $1,100. Anyway, so we got a total tax of 5367. I'm sorry, 5377. I think it's going to be 5367. Okay, I think that's what we're going to see when we actually do the correct question, because I saw the tax tables said 5367. So I think that's what it's going to be. I think that's why I was a little bit confused. I think, why is it? Are they giving you a little break for using the tax table? I don't know, but now I figured it out. That's a mistake. That should be a 0. Okay, so I hope you get the idea. The marginal tax bracket. Most people don't really know their marginal tax bracket. They don't really care. They don't want to do the calculation, but it's not that hard, and it's very important because you have to think about that marginal tax bracket. The next marginal tax rate, the next dollar you make is going to be taxed at that current marginal rate. All right? So forget, you've passed 11,000, forget the 10%. You've passed 44,725 if you're single. Forget that 12%. You're now in the 22% bracket, and that's why we used 22% in the previous presentation, because a lot of people are in that 22% tax bracket. Of course, if you had gone over 95,375, you'd be in the 24% bracket. Once you hit 182, 101, you're in the 32, 35, 37. You see, these people, once you're making $500,000-$600,000, folks, you're paying over 1/3 of your earned income to the government. And that's why many of the very wealthy people, millions of billions of dollars, will do their best to not be paid taxable income and instead be paid in capital gains, which are taxed at a lower rate. And it's a bit of a scam, and that's what is going on now. You might hear about the wealth tax because some of these people, billions of dollars, and they're not happy. They're not happy paying their taxes. I don't feel too sorry for them, but that's everyone's different. Okay, so now let's go back to the average tax rate. You'll hear people talk about the flat tax. Well, let's take a look at what the average tax rate for this single taxpayer. Remember, the first 11,000 was at 10%. The next group was at 12%, then 22%. You take the 5377. Was that what that was? Wait a minute, I'm confused now. Let's go back. 5377. It should be 5367. My apologies. Divided by the taxable income, 45,725, gives us about 11.8%, almost 12%. Who would win and who would lose with a flat tax? Well, the folks at the top would win big time, and the folks at the bottom would lose. But hey, Republicans are very good at framing the argument as simplicity, and the middle class goes, "Oh, okay, I like simple. I like paying more taxes." Because if we were to go to an average tax rate, it would probably be between 17 and 20%. Yeah. So people at the top would pay less, people at the bottom would pay more, but there you go. That's what democracy is all about. You have to be a well-informed citizen and make your voting decisions carefully. And contact your elected representative and tell them what bozos they are. Slide number 24, the marriage penalty. If marginal rates are higher for single taxpayers, how come we sometimes hear people complain about the so-called marriage penalty? Well, because the second wage earner in the family pays their taxes at the highest marginal rate, they don't get to take advantage of the lower tax brackets. Are you with me? One person's making $50,000, the next person starts making money, their income is going to be taxed at that marginal tax rate of the first person. Actually, if you're a married couple with only one wage earner, you get rewarded, not punished, but of course, they need more money because they're two people. Now, in 2027, they removed the marriage penalty for all of the brackets except the very last one. So you'll notice that all these brackets are doubled. 11,000, 22,000, 44,725, 89,450. They're all doubled until you get to the end. And notice that, no, that's not double. 578, 125, you don't double that. That's not double the last tax bracket. However, they created a new marriage penalty. Both single and married filers have the same $10,000 state and local limitations that we talked about on Schedule A. Yep, another Republican attack on the blue states. I hate that, folks. I hate using red and blue states. It just, it reminds me of the blue and the gray and the Civil War, and I hate it. There are United States, but some are more Republican and some are more Democratic, and we keep yelling and screaming and hollering at one another instead of actually working together. But hey, there's an old saying, in a democracy, the government is a reflection of the people. We want to yell at the government and point at them, but we got to remember there's three fingers pointing back at us. It's our problem. We are the government, essentially. We are a reflection of the government, and it ain't a pretty sight. Slide 25. Okay, Schedule 2. Well, we're not going to even look at it. But there's the dreaded alternative minimum tax. So let's go back to this guy and notice that here it is. This is where it would go right here, the alternative minimum tax. Forget it. Most people are not going to be affected by the AMT. But more and more of the middle class will be affected as their income rises and they have more deductions from home mortgage interest. It was originally meant to make sure everyone who could afford to pay would pay some taxes. It was originally targeted to the very wealthy because in the 1960s, there were a lot of people making millions of dollars who weren't paying any taxes. So, that didn't go over well with the voters. And so the Congress said, okay, we'll create this AMT. But in 1969, I think is when it was created, $100,000 was a very unusual and substantial income. I mean, that was a lot of money back then. It's not that much now because of inflation, and that's just the way the economy works. If you're making $10,000, $12,000, you were doing all right. The AMT is affecting more and more of the middle class as wages climb with inflation, especially in the democratically, the more affluent California, New York, the East Coast cities, and Chicago and the like. It was eliminated for businesses in the 2017 tax bill, but not for individuals. Okay, thank you very much. All right, now let's go back to the form and take a look. Are you still with us? Relax, we're on the home stretch here, folks. Yeah, many of these things are not going to affect you folks, except if you have children. Notice, they want you to put if you don't put it again here, they 3649. They want you to duplicate it here. If you don't do it, don't worry, they're not going to get angry at you. But notice that A King has a child at under 16 years of age, and so he gets to take advantage of the $2,000 tax credit. Now, this was bumped up during the pandemic, and there's talk about making it even bigger, and then politics are going back and forth. But for most people, this is going to be their major tax credit. Wrong one. There are all types of tax credits that we'll discuss we'll discuss the effective tax credits. But tax credits are very, very cool because why? They allow us to take a dollar for dollar deduction of our taxes. I should. There's a mistake here. I think it's each child under 17, so age 6 to that was just for 2021. Okay, so we love tax credits, and that's we're here looking at these guys here, other tax credits here. But finally, we get the other taxes here, self-employment tax. Most people are not going to be affected by that on these lines. So finally, on line 24, we know how much taxes we're going to pay. We have the tax from the tax table. A. King has the $2,000 tax credit, which reduces his taxes dollar for dollar. And finally, we know that he has to pay $1,649. So let's take a look at the presentation. Other taxes, we'll get to that in a bit. Let's go to tax credits. We'll come back to this. We'll come back to this in a minute. But tax credits are very cool, folks. Tax credits are a dollar for dollar reduction of your taxes. The tax deductions that we talked about in Schedule A, they are reducing your taxes by the marginal tax bracket. So if you're in the 22% tax bracket, 22% times 100 is $22. If say you're in the 7%, we could be in the 4, 7, 6, or whatever. California, you have a total tax reduction of only $29. But if you have a tax credit of $100, you reduce your taxes by $100. Now, there's never a reduction in your Social Security taxes. So this isn't a tax discussion. A tax credit is the amount subtracted directly from the amount of taxes due. Tax credits are worth more than tax deductions. So let's go back to here. So finally, we know how much taxes we have. What's going on here? Okay, right. Back. We're going to go back a slide. Now, some people have other taxes, and that's on Schedule 2, but most people are not going to have that. If you're self-employed, you have to pay your own Social Security. That goes on Schedule 2. If you have anybody working in your house, you have to pay their Social Security taxes, and that came about, believe it or not, from a political football that happened way back in 1992-93 when President Clinton was elected. He nominated the first woman attorney general, Zoe Baird, to be the attorney general. And she was an eminently qualified prosecutor. Everything looked good until it was found out that she had hired a nanny and didn't pay the Social Security taxes. And oh my goodness, well, that's the end of Zoe Baird's ability to be the attorney general. So Bill Clinton is determined to hire a woman. So he gets Janet Reno. Again, another eminently qualified prosecuting attorney to be the top cop for the United States. And yet she's not married. And she said, look, I'm lesbian. I just never got married. No one's ever asked me. And you cannot make this stuff up. You cannot make this stuff up. All of a sudden, men from all over the country started sending her saying, I'll marry you, little lady. I'll make an honest woman out of you. Fact, dear students, is always greater than fiction. Anyway, Janet Reno went on to become a very accomplished attorney general, and we're very proud of her. So, hooray, we've made it. Line 24, we now know how much taxes we have to pay. And so, we talked about tax credits already. Here's that W-2 form, the little snitch that tells the IRS how much you made, how much you paid in taxes, Social Security withheld, Medicare, all that stuff. So yeah, you can't get away with it. They know. And sometimes they do make mistakes, folks. Make sure your employer doesn't screw up, because I got messed up once. Somebody sent the wrong information in, and the IRS said, wait a minute, something's not right. And I said, you're right, something's not right. And so I went to the employer, and they fixed it, and everything was fine. Now, line 25, withholding. The IRS says you have to pay as you go. You can't just wait until April 15th of the next year and pay all your taxes. They'll hit you with a penalty for doing that. So you get money taken out of your paycheck. If you're self-employed, you have to send in your quarterly estimates of your taxes. And many people wind up getting a big refund. Well, what you're doing is you're giving the feds a free loan. With interest rates so low, it's really not a big deal. Unless you're using the refund to pay down your credit card at 29%, 25% or whatever. So you want to do your best to estimate your tax bill. Now, what are these two numbers? They might come in handy later on, 90%, 100%. Think about it, maybe in an assignment for chapter 3. But if you don't, that's fine. Some people they call it forced savings. And yeah, I do my best to try to get, so I owe them $100 or they owe me $100. Now, I'm not usually very close because it's very hard to estimate our taxes, but still, that's the idea. And then any other pay, so that's the W-2 form, and that's what most people are going to have. All these other things may apply to you. If you have any Form 1099s, they go here. Any earned income credit, which we discussed a little bit, that's if you, depending on how much you made and if you have kids, they might turn around and give you more money. So here are more of those credits we talked about. The additional child care credit. If you have more than, I think, 3 kids, you have to fill that out. American Opportunity Credit. If you were taking college classes, you might apply for that. And then I like this, reserved for future use. So, but most people are not going to be affected by this. So we put in the $2,000 that we paid through our W-2, our employer paid, and we put that subtotal here. And then total payments here on line 33. And finally, now we know what our total payments are. We're finally done. Whew! Whew! Oh my goodness. Okay, now you're going to go back over this stuff and go over it again, right? A couple times, and then look at the example. Do the second text exercise. Yeah. Now, if you've paid more than you owe, obviously you've overpaid, and then put this number again here so they send it to you. Well, some people, what they'll do is they'll roll it over to the next year, where you can instead of putting the 351 here, you could put it here, and then they will roll it over to the next year. I don't know. Just like, give me the money now. If you paid less than what you owed, if this number were greater than this number, then you'd have to put that down here and send the money in. You got to pay them. What's this estimated tax penalty? Here's where if you had not paid enough or you waited until the end of the year to pay, they might hit you with a penalty. But usually you could say, you can write a letter. I've done it for people. Write a letter. Oops, I goofed. I didn't have enough taken out. Will you waive the estimated tax penalty? And so far, they've always done it because they know how difficult. Who better than IRS agents to know how difficult this stuff is? So if you say I goofed, they'll say, yeah, you're not alone. We goof a lot. So you sign it and date it. Don't forget to sign and date it, because if you don't, oh my goodness, then they get a little upset. And don't send another one in. Call them, contact them, and they'll send you out what's called an affidavit, I think. And they say, okay, here's your signature for the return for this year. And then don't forget to put your occupation. And of course, A-King is a mattress tester. A-King back is a mattress. Of course he is. Why do they want to know your occupation? Well, because they use algorithms that say, wait a minute. He says he's a corporate lawyer and he's making $60,000 a year. That doesn't make sense. We had a client once, not a client, a student. He was a very colorful individual. He's since passed away. It's very sad. But he was from Northern California and he came down here. He had been growing marijuana up in the Humboldt area, which has got lots of good soil for marijuana. And a lot of times when a drug dealer or drug manufacturer or whatever is captured, they don't get them for the drugs. They get them for not paying their taxes, like Al Capone. He would fill out his taxes. He paid all his taxes. And what did he put down for his occupation? Not marijuana grower. He put down cut flower gardener, cut grower, or something like that. He put down he was a nursery. He grew cut flowers, and he wasn't lying. And so the IRS said, oh, okay, well, we can't go after him. But the state went after him, and he spent some time in the state, not much, in the state penitentiary. And he was very upfront about the whole situation. So there you go. There's a 1040 form, and you're going to go back over and do this again, right? Yes, 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 yes. Now, how to avoid filing errors. Check your arithmetic twice, 3 times. As we said, some people add when they subtract, and vice versa. Attach the necessary documentation. Make sure you put your social security number on the check. You put your tax year, the form number. United States Treasury, don't make the check out to the IRS. Photocopies, put proper postage. Better yet, file electronically for free. The IRS is working on eventually getting rid of TurboTax and the others. And not because they're not good companies, but boy, they really try to screw you. They really, really try to screw you. They're always trying to hit you for more upselling, and then they told the IRS, oh, we have these free options, but then they hid them so people couldn't find them. And then they finally said, we're sorry, and then now they come clean. Check everything again, and if you need more time, file an extension. That's one of the questions. How long do you get to file an extension? You get an automatic extension. All you got to do is ask for it, folks. Think about it. Uh-oh! Uh-oh! If you find you have made a mistake, should you leave the country? A. B. Commit suicide. C. Pretend it didn't happen. This is what a lot of people do. And folks, the IRS, they are slow. There's no doubt about it. They are slow. They are overworked. They've been going to the Congress for years, and the Congress allocated a bunch of money to help them modernize, and the Republicans took it away. But don't pretend it didn't happen, because eventually you'll get that letter in the mail, official business only, saying something's not right, you got to deal with this. Or file 1040X. Yeah, obviously the correct answer is file 1040X. If you catch the problem before they do, I don't know, I used to know somebody who worked intimately. I used to know somebody intimately who worked at the IRS for many years, my mother, and she would cry, nobody knows what they're doing. Everybody's so confused. So they're not, they're human. They know what's going on with here. So you file it first, and they'll go, oh, cool, this person, figured it out before we did. Okay? Okay. And now finally, oh, darn, don't forget the state of California. Well, once your 1040 is finished, you get to tackle the state of California's Form 540. And fortunately, it is far less than half the work. Q1040, 540Q. Usually just 2 forms, especially for the homeowners. There's the Form 540, and then there's the 540CA for California adjustments, because California doesn't tax unemployment benefits. The United States does. California taxes something that the United States doesn't. I forget. Oh, right. The United States does not tax interest on some bonds, and the California does, and vice versa. So there's a few adjustments that have to be made, but mostly it's pretty straightforward. And again, if you go with one of these services, they'll help you file it electronically and charge you, of course. But California has been one of the states. No, it's not the only state, but it's been one of the states that's been really pushing the IRS to say, look, we gotta let people do this for free, because they don't want you to send them paperwork. They want everything electronic too. So, I know. Are we trying to make you tax preparers? No. We hope you go in January and apply for the VITA volunteer income tax assistance. You get college credit. You get a certificate from the IRS saying you're a preparer. You can prepare tax returns, and it looks great on your resume, and it could be a career. But really, we hope you go back and slog through the tediousness of this endeavor and realize that it's really not that hard. Yeah, I apologize. It is hard. It's very, very frustrating sometimes, especially when you run into something that doesn't make any sense. Why are you asking me this question? And then you look it up and maybe you figure it out. But we're really, really proud of you for making it this far. Use the first tax exercise as a guide to do the second tax exercise. There's an answer key, and And then you're going to do the assignment, which is going to look just like the first tax exercise and the second tax exercise. There's going to be little asterisks for where you're going to put your numbers, where you're going to put your answers, and realize that we're very, very proud of you. Look, 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 a little over an hour. That's what we were shooting for. And if you have to, break up the presentation. I'm not going to break it up into 10 pieces just so that they're all 4 minutes long. Thank you so much for being in our class, dear students. All of us at Southwestern are really very proud of you. We're honored, grateful, and we're really happy that you're here with us. And we want you to be awesome. Now, in our next and last presentation, we'll discuss some tax strategies, where to find information, and then we'll be done with everyone's favorite topic to hate, taxes. See you in our next presentation.